Hi, everyone. Thank you so much for joining. It's our FOMC preview. We're also going to have a bit of Bank of England in there. But I do just want to tell you we had the Bank of Japan release their latest interest rate decision earlier. There was no big changes from them, actually. They kept rates on hold, and they certainly didn't signal that another rate hike, remember their hiking rates to normalize them, was going to be on the cards anytime sooner than what the market expects already, which is about a cut around about July. But let's go back to the key event for this week, and we can't doubt it. It is the Federal Reserve. They are not expected to change interest rates, but that doesn't really matter because we're looking at so many other parts of that meeting, including the latest economic projections, the dot plot, and also the Jerome Powell's speech. There's been a lot of expectations as we move into this meeting. As you know, since the last meeting, we've had a massive rout in stock markets. In the last few hours, we have seen US stock futures try to pick up. We've seen the likes of Tesla, that's up a few percent already today in the pre-market. Nvidia is also higher. That's after those big tech sell-offs yesterday and on Monday. But I think market enthusiasm to build on those gains that we're seeing is really, really limited. And stocks are going to remain hampered until we get the outcome of this Fed meeting. Now, we're going to take a look at some charts. Bear with us. Right. What you're looking at right now is overall global stock markets. Now, I want to show you a few things. US markets are closed, but the flashing lights there show you that European markets very, very quiet leading up to this. If we look at the last two, columns on the right-hand side there, sea of green for Europe, sea of red for the US. This is year-to-date gains. As you can see, massive underperformance by the US and outperformance by Europe, particularly German. The DAX index is up 17% year-to-date, largely down to that defense budget spending that they're doing. But actually, it was doing well before that as well. If we change this to the last month, so that's since the last meeting, we've really seen a sharp sell-off. So the Nasdaq is in correction territory. It's been down 12%. The S&P 500 has been down 8%, so nearly at that correction territory. However, if we go back, if we zoom out a little bit, and remember the Fed will always zoom out, they're not just looking at the end of their noses, we've only seen a decline of about 4.5%. So a lot of people have been talking about the Fed put, about the Trump put. Those puts do not exist, we don't think. People are looking for this circuit breaker to try and get US stocks to find a bottom and then to rally from there. We do not think that a 4.5% decline so far this year for the S&P 500 is enough to trigger the Fed stepping in and saying, yes, if the index continues to fall, we'll cut interest rates. In fact, we think, if anything, they're going to be very wary about cutting interest rates, and we will talk about that soon. Now, this chart shows you the S&P 500, and it's got these simple moving averages on it. So it's a candle chart. Now, the yellow line in that chart is the 200-day moving average. This tells you the kind of long-term trend. So what this chart shows you is that we have fallen below that long-term trend. So that decline that we've seen, particularly in the past month, has really changed the trend for the S&P 500. So it's no longer moving higher. There is a saying that says anything that happens below the 200-day moving, nothing good ever happens below the 200-day moving average. And I think some stock market bulls will agree with that sentiment. But as you can see, just on the right-hand side of this chart, we're very much in a consolidation pattern. Part of what will be needed to determine whether we go higher or lower will be the Fed's assessment, and particularly its assessment for the economy. Now, I also want to show you something. This looks like a real headache of a chart, but it's not. It is the Fed's dot plot. So it's all the Federal Reserve members get to put down their predictions for where they think interest rates will be. They get to update that prediction every 3 months. So this is the last prediction that came out in December. Don't look at 2024, but 2025, they're expecting interest rates this year on balance. The median expectation was for interest rates to be about 3.8%, and then to fall further into 2026, 2027. So we're looking at about that 3.9, 3.8% level. And I just want to show you what the current expectations for interest rates are in the US. This is the work chart. So it's world interest rate probability. Again, it looks like a headache, but it's actually a great chart. If we look at implied rates, where you can see I am pointing to now, the implied rate for the end of this year is 3.75%. So it suggests that the market is a little bit less, a little bit more dovish than the Federal Reserve were in December. But we have seen that real big decline in stocks. We've seen that decline in bond yields, and we've also seen this absolute change in the economic environment. So it'll be really interesting to see what the Fed does there. Now, I just want to show you the extreme moves that we've seen in bonds as well. Now, if you look to the very far right-hand side, that column down the far right-hand side shows you bond yield changes in 10-year global bond yields for the past month. Now, the first line is actually American yield. So the US 10-year Treasury yield has dropped 23 basis points since the last Fed meeting. Now, what does this mean? Let me just bring you guys back up here. What does this mean? Well, it essentially means that the market has priced in quite a dovish stance from the Federal Reserve. Yet, the Federal Reserve, if you actually look at how if you take on aggregate what they've been speaking about, you'll see that they've actually been moving more towards the hawkish side. So if anything, if they do throw a bit of a hawkish surprise today, we could see a big reaction. That could be the second leg lower that we see in stocks that could then give a really kind of good clear out. And then we may see the Fed decide that they need to step in. But I think we are expecting some big changes to growth forecasts. Growth forecasts are likely to be revised down. Inflation forecasts are likely to be revised up. Remember, they forecast PCE inflation. If we see PCE, which was revised up in December to 2.5%, if that moves to 3% or gets a 3% handle, I think that could speak markets. That could lead to another sharp leg low of the stocks. And we could also then see a bit of a turnaround in US bond yields. I just want to show you that one quickly. This is the 10-year bond yield. As you can see, it's really fallen back quite sharply. It was about 4.8% at the start of this year. I think if we get a dovish surprise, then we'll head towards 4%. But if we don't and they throw a hawkish surprise at us, that could really turn this around. And we could see a run back up, certainly to that 4.5% level, maybe even back to the 4.6% level from mid-February. Now, that has a big implication. What does it have a big implication for? The dollar, the one thing that we have missed. Also stocks, but I think we know the direction of travel. I want to show you dollar yen. Dollar yen is very sensitive to Fed meetings. As you can see, this is the dollar had been weakening, the yen had been strengthening since January, but it found a bottom actually last week, and it's been and dollar has been rising versus the yen since then. Again, a hawkish surprise, and we could see get back above over 150. The fact that the Bank of Japan didn't sound more hawkish as well, that's really impacting on dollar yen. So we're seeing a bit of dollar strength today. If we look at the euro as well, again, the euro's had just the best run up, the strongest run up since 2008, I believe. And that has faltered around about that 110 level, just before that 110 level. And actually, in the lead up to this FOMC meeting, certainly with dollar yen, also with euro, we have seen a bit of dollar strength come in. So it's not just, it's a little bit of consolidation as we wait for the Federal Reserve. That's to be expected because we're waiting for the Federal Reserve to tell us what is going to be next. Now, it's not just the Federal Reserve that we've got this week. Tomorrow, we've also got a Bank of England meeting. They like to keep us on our toes, these central bankers. No change expected. Remember, the central bank in the Bank of England tends to hike interest rates once a quarter at their monetary policy meeting, and the next cut to rates, is expected in May. So at the May meeting, not tomorrow, where actually we're not really expecting too much because there won't be a press conference, but there will be a statement, and that will be worth watching, particularly around fears about inflation, fears about growth, all caused by these trade wars. So far, the UK has managed to keep out of them. And so far as well, the sell-off in UK assets haven't been too bad. One thing worth noting, though, we are backing away from that 130 level. This is the cable chart. So the sterling versus US dollar. Sterling, like the pound, like the euro, like the yen, they've all rallied against the dollar since the start of this year. The pound has been pretty good. It did reach 130 yesterday. That's a key psychological level, but it has backed away from there a little bit because we are waiting to hear from the Fed. Again, a hawkish surprise from the Fed could really trigger a stronger dollar. It could also trigger weakness in stock markets. Now, last but not by no means least, I did want to show you gold. I'm just going to bring my gold chart up now because the gold price has continued to soar. It's life above 3,000, as you can see. Let me just chart that so you can see it. Life above 3,000, and it's just showing kind of no end, really. I think the current environment that we're in, it's had a fantastic run over the last year, as you can see, pretty much full uptrend with limited pull drawdowns, and we're not in that space yet. I think we're going to consolidate around about 3,000, and I think 3,000 now is a really key support level for gold. Just the environment that we're in, inflation threats, global growth threats, geopolitical issues as well. This is a really, really good environment for gold. So we do expect that to continue. But overall, I think we need to look at the Federal Reserve as being the key event this week. And tonight, I think it's really important. I think everybody is looking, all the markets are looking at the Fed meeting. They're looking to see what it means for greater clarity on where interest rates will go, what the economy will do, give the Fed's assessment maybe about how President Trump's trade policy is impacting the economic outlook in the US. And I think the dot plot is also really, really important. We will be covering it live. We will be sending out notes, and we will also be doing, we'll be tweeting as well. So do follow me on Twitter, on X, sorry, I should say, if you don't already. But yeah, we're going to be watching a few things leading up to that meeting. Does the dollar maintain its strength? Can tech stocks continue to rally? But overall, we don't think there's going to be any big moves in the lead up to this meeting. The Fed meeting is going to set the tone, certainly for the rest of the week, maybe even for the rest of the month. So thank you so much for joining. We really appreciate it, and we will speak to you soon. Bye-bye.